Welcome everyone to today's RaaS Research Group Stocktake webinar, where we will dive deep into the analysis of a promising ASX listed stock. Today, our focus is on Empire Energy Group, ASX code EEG. Our session will begin with a comprehensive analysis presented by RaaS Research Group Senior Analyst Andrew Williams, who has recently released research on the company, and he will cover the main themes, financial models, potential upside and risks that every investor should consider before making an investment decision. You will also see a detailed presentation for him, and Andrew will be available at the end to answer any questions you may have about the company. Following his analysis, you will directly hear from Empire Energy Group MD and CEO Alex Underwood, who will provide an in-depth presentation about the company, its vision and future prospects. After the presentation, we'll have live Q&A. So get your questions ready and submit them using the Q&A function on your screen. They can be submitted at any time, and I will put them to both Andrew and Alex at the completion of the formal presentations. Thanks for joining us, and without further ado, let's get started. Please join me in welcoming RaaS Research Group Senior Analyst Andrew Williams for his presentation. Andrew, over to you.
Thanks very much, David. Good afternoon, good morning, everyone. It's my pleasure to be on the Stocktake webinar to talk about Empire. I've been following the company since early 2020 and have been very impressed by the progress made towards first gas in what is effectively a virgin basin. And even 4.5 years ago, having to answer questions, there's been no shortage of skeptics really questioning the wisdom in chasing Beetaloo gas. Although I'll touch on a number of points, I think the thing I'd like to really for people to take away, and that what shouldn't be taken for granted here, is that with EEG now standing on the cusp of initiating production, first production out of the Beetaloo, I think we need to acknowledge that that is a massive achievement coming from what has effectively been a standing start in a play that in relative and maybe even absolute terms has been unsupported by infrastructure, or can even point to an analogue of developments that would love the risk. I will start with a word of caution that we're not there yet. It is geology and it is engineering, and things will go wrong, but the success case should be able to deliver a multiplier effect. And David, if I can move to slide 3, please, I'll make that slide 4. And I will, next one, please, David, and we'll start right with the what, why, and why now, as you would always say in a morning meeting. The what is looking at a company that is on the cusp. The countdown to first gas is there. It's new gas in a supportive macro environment. It's a thematic that the market has taken a little bit of time to it's taken a little bit of time to come to grips with, but it is that momentum is now starting to shift, and more investors are now beginning to embrace what is a very active and one of the better thematics on the market. Gas prices are going up. We know that. Demand is holding, notwithstanding the fact that there was, I guess, a lot of dire predictions about demand destruction, and supply is falling. The why, self-explanatory. Low cost, high leverage, new gas at scale, pricing at a discount to peer group metrics. And the why now? Well, it's really about the 6 inches in front of your face. It's development drilling, fit and financing to follow first gas by mid-2025, and well ahead of the peer group, not just Northern Territory peer group, but also even Queensland new gas developers. Next slide, please, David. So I will have a quick map. I noticed that Alex is going to have this in more detail, but it's a massive footprint in the Northern Territory, and one of the things that I guess has always been an issue is how do you high grade that? Well, they've managed to do that, high grading down into Carpentaria, where the Carpentaria area, where you can see that in the middle diagram, and effectively that's moving to the eastern edge of the Beetaloo Basin. And then on the right hand side, you can see that in comparative terms, there's a high density of wells there, with the 5H well to be drilled coming up. And also, I would like to highlight the proximity to the MacArthur River pipeline, which is a very strong point of differentiation for what Empire is going to be doing in terms of short-term, but also in sort of medium to longer-term growth. If I could have the next slide, please, David. I'm just going to call this reasons to like EEG, and this is a very simple one. I like pathways that are simple. I like stocks that are clean, and where with the primary listing on the ASX, really where the stock price goes is going to be dependent on what happens in terms of delivery of field results. Next slide, please. High working interests are good. They give you strong leverage. It makes it a bit difficult when you're at the start, having to finance things at 100%. But the one thing it has allowed EEG to do is determine the scope, the timing, and the pace of the works as it moves forward. Early stage works generally can deliver material de-risking through proof of concept success, and that proof of concept success then gives you the potential to partner, and generally bigger companies don't like partnering where there's higher risk, so that proof of concept can then provide a premium versus standard equity issue pricing. Now, when you hold assets at 100%, at some point you're going to need to chase financing. We understand that. So there will be leverage, there will be some dilution, whether it be at an issued capital base or at an asset level, at the asset level, but it does provide you a stronger base to move forward within those discussions. Next slide, please, David. Very simple, and Alex has a great slide in a few of his presentations that demonstrate this. It's lower CapEx. The focus on the shallower part of the Beetaloo in EP 187. So if you're 1,000 odd metres shallower, you can drill holes cheaper. And importantly, as I understand it, the Valkyrie target zone is effectively the same thickness as you move closer towards the edge of the basin. So you're effectively getting more bang for the buck. The thing that I think really makes provides the material operating advantage, commissioning advantage, and capital advantage is the massively good deal that they did in the purchase of the Rosalind Park gas plant. Very low cost. The gas spec is around about the same of what it's expected to be processing here. So it's a proven project and a proven plant. So on lower CapEx, with effectively the ability to have lower sustaining gas rates, and you can move into higher margins. It really is just that operating, commissioning, and capital advantage. Next slide, please, David. So the company's just leading on into the straight on the path to first gas. Both Empire and Tamboran are looking to target an FID around about the same time frame, but Empire is now looking at by about mid-2025 of being first gas, and I think that is at least 6 months. But realistically, I think with Tamboran chasing a bigger project is probably going to be more like 9 and maybe even 12 months ahead in terms of first gas into the market. And what makes it even better, I guess, makes it a stronger case, is the binding GSA that they've recently announced, having completed with the Northern Territory government, that effectively underwrites that pilot phase for 10 years. So ramping up to 25 terajoules a day with further options on gas growth, and that with a reputable counterparty becomes bankable. Next slide, please. Into the straight on first gas with organic upside. The beauty, I guess, of the gas processing plant is the nameplate above pilot. So 25 terajoules at pilot, 42 nameplate, that's 68%. And in broad terms, in very broad terms, all it requires to get there is more wells. You have organic upside within. And I guess that's a very, very strong operating advantage. Inherent, rather than having to build or go through a new build on a plant, where setting of the nameplate on that plant comes with overcapitalisation risk or even inherent latent risk that it sits there waiting for gas to fill it. Next slide, please. So I would say the development design here, or the well development design, is lower risk. If you don't have a whole series of analog wells in your area, in your play, then that you can tag and say, well, we know that works and that's what we're going to follow as the model, then the best thing you want your company to do is to at least have approximated that development model through your own early works. And going back to the slide, no, we don't have to go back, sorry, David, but going back to the maps we showed, and I think Alex will show in a bit more detail, the 2H and 3H wells drilled from the same pad back to back has given the company at least an approximation of that 3,000 metre lateral and multi-frac stages. So in relative terms, it becomes a model that is lower risk within Empire Energy. Can I have the next slide, please, David? Again, coming back on the diagram, I think the point to note is the proximity of the MacArthur River pipeline, which is literally a few hundred metres away from where gas is going to be coming out of the field. So in order to get to pilot and pilot up to ramp, and in order to even look at the organic growth, it doesn't require a major infrastructure build to start up and to service that growth. Next slide, please, David. I've said equity finance the first gas. That's my terminology, and I guess we should be looking at cash at hand now that we're getting close to the end of August and maybe around 50. That recent raise that was done back in April should be sufficient, in my view, to get to or through FID, certainly from an equity contribution to capital cost basis. I think the recent share price, sort of the peak and the current share price, I can interpret as being the market having greater confidence that further equity capital requirements to first gas are low risk. So it's really removing that equity capital overhang out of the stock, which I think is very, very important. Now, I've said they're equity finance to first gas. The caveat I'm always going to put on that is never say never. Next slide, please, David. So I just want to touch on the operating environment. I think anyone who's investing in Empire and anyone who's investing in a gas stock here probably knows as well as anyone what's going on in the operating environment. The macro thematic's only getting stronger. ACCC, AEMO projecting to a gas shortfall, future gas strategy. I think the federal government's had a come to the light moment, saying new sources of gas of new gas supply are required. I will say that the ACCC and AEMO models are based on a supply number that I think is the weakest point in their modelling, because subsurface performance is intrinsically difficult to forecast with any accuracy, and the further out you push those numbers, the more the error envelope around that number is. It just gets bigger. We've seen Exxon talk about the issues it's got at Longford and in Bass Strait. We see the Cooper Basin supply numbers on a daily basis through the AEMO website. And we've seen the issues that are happening in Queensland coal seam gas, particularly with the sweet spots of Fairview and Spring Gully that have been heavily produced. So the next sources of gas in these areas are going to be lower productivity, higher cost, and whether they can actually be brought on in time and whether existing big supply sources can keep going is an area of immense risk. I think the only thing you can say with any certainty is the big gas supplies are in inexorable decline, and abandoned timing is subjective, and the supply risk in that model that these government quangos are using is to the upside. It could be, the shortfall could be bigger and it could be sooner. Next slide, please, David. I also always want to touch on the Queensland gas options because, again, part of the argument is why do you want to go to the Beetaloo, which is new, to try and get gas when Queensland has a a massive infrastructure, a deep infrastructure network, and has all those analog fields. But for the last 5 years, really nothing has happened, and certainly nothing material has happened. Why is it stuck? It's partly financing. It's partly sitting back and waiting for the macro to pick you up in a wave of either M&A or new infrastructure developments. It's partly waiting for more gas upside, joint venture issues, regulatory issues, and we can just go lock in Eddie, it's all of the above. The paradox is waiting has resulted in higher gas prices, but with timing delays to first gas, capex inflation, the need for stay-in-business capital raisings, although the NPV might not have moved very much, the dilution at the per-share level has been probably higher than it should have been. And I think EEGs is a prime example of, if you want to invest in small companies, you want to invest in ones that are working their asset and making progress. Next slide, please, David. Does the operating environment get any better than this? No. And why Northern Territory provides gas at scale. And the three things I think when you're looking at it in terms of gas real estate is always position, but in the absence of position, what you want is scale. The prediction shortfall from the AEMO is that maybe 60 petajoules per annum in a few years, that's 165 terajoules a day. That translates to about broadly a 1.2 million tonne LNG import per annum, and that's a big number. So where you've got to go is to go somewhere else at scale. What we do like about it, this is at scale, is that there is consistent and correlatable geology, which means that success cases can transfer, and what works in one area is likely to work in others. So again, cookie cutter, but it's reproducible and repeatable. Next slide, please, David. Risk to gas prices is to the upside. If LNG terminals come in, and there's an AFR article on Monday that you may want to go back and have a look at, it basically says an emphatic yes, that at some point LNG import is going to need. Well, then that puts marginal import parity pricing at East Coast gas supply. And that's only at the import terminal. So you still would then have to add tariffing to get it where you want. And then that will flow back into domestic pricing and provides an opportunity. We know there's a $12 gas floor, but the upside could be materially higher than that. And next slide, please. So I wanted to start talking about some of the risks at a high level. EEG is not the only Northern Territory operator, and given the infrastructure restrictions or constraints, there will be competition for what is at this moment a relatively small market. But having a first mover advantage, having cheaper costs, and being able to get up and running at a smaller scale initially does provide a modicum of comfort that, although it is a risk and there will be more gas being produced in the Northern Territory, that EEG still stands ahead of that. Pack at the moment. Next slide, please, David. Not the only company chasing gas, not necessarily just in the Northern Territory, but elsewhere. We do know there's a massive offshore Otway Basin drilling campaign set to kick off sometime in the next quarter, targeting in aggregate a fair amount of gas, but individually it's going to take a lot of wells to be able to aggregate that new gas, certainly up to scale. We noticed some decent and encouraging early stage results coming out of Queensland CSG chasing the deep Bowen Basin, but early scale, and is going to provide a lot more work to come. However, there are companies chasing more gas into a market, so it remains a risk. Next slide, please, David. There are other potential sources of gas. Now, we just talked on LNG imports. Now, the advantage is that you can put an import terminal very close to your end market. So you can stick it close to Sydney, you can stick it close to Melbourne. But I will note, historically, there has been a very, very strong NIMBY factor, and even AGL going back a number of years with its Crib Point LNG proposal, import terminal proposal, had enormous environmental and residential issues, and that is a project that has sunk below the waves, never to come back. But consensus is there will be LNG import terminals at some point, which then provides competing sources of gas, and maybe just some pricing or locking out some East Coast markets or southern markets from Northern Territory gas. Next slide, please, David. Look, Beetaloo is still a work in progress. When we talk about the Beetaloo and we talk about what it could deliver, the Marcellus is often brought up as a working analogue in the US onshore. I would sort of highlight that the Marcellus has to date around about 12,500 wells drilled. Projections I've read would suggest there's another 11,500 wells to be drilled over the next few years, chasing 180 TCF of gas. So new wells almost in the Marcellus almost become predictable. We're certainly not at that point within the Beetaloo. And again, as I said earlier, it's geology, it's engineering, and there will be some issues, and there will still be room to surprise either up or down on all the things you need. Geology can be a twilight zone, but if you're looking at just expanding out from an original footprint, and you're talking about 3,000 metre wells, and maybe you're talking about 6,000 metre centres, 6,000 metre centres should come at relatively low expansion risk. However, geology doesn't always work that way. We still need more wells in the play. Next slide, please, David. And the last thing I want to talk on here is just the financing. I've said never say never on equity, and that comes for all operators, particularly operators in the whole industry who at the moment do not have any revenue streams. Although partnering at a proof of concept could lead to a premium, what you really need is an auction effect to maximise that premium. And Origin have left the Beetaloo, Santos seem to have parked it. So it's going to take a new population, a new group of big company investors that want to come in and have a look, and that may take a while to come out. So partnering may come at a discount. Debt is always an option, particularly when you've got bankable gas gas contracts. But debt options can be expensive. And the thing you need to be aware of is, or the company will need to be aware of, is how much cash can get swallowed by debt servicing in a play where even sustaining capex right now is still somewhat uncertain. Can we move to the next slide, please? Right. It is all subjective. Early stage plays are, and again, I'll just highlight that, it's by definition somewhat speculative in nature. The way we have tried to apply a value is looking at converting the resource potential into a producible reserve using a whole series of discount factors, then applying from other analogue producing gas projects at the same sort of scale Australia-wide onshore, and then looking at the margins driven from them in terms of operating NPV margins, and then applying a matrix approach against low side and high side to low side and high side reserves versus operating margins to come up with our valuation. It is subjective because discount rates and probability factors are all in the eye of the beholder, but it allows you to at least get a value as to what the opportunity set could deliver. And the opportunity set we're seeing for Empire at the moment, we have restricted only to EP 187, where that pilot project is going to be, even though you can extrapolate that on a broader scale across the whole of the Beetaloo, but the number is so massive, the last gigajoule from the last year of production is effectively not what's going to drive the stock now. It's about what you can see in front of you, and that is Carpentaria uplifting and de-risking across all of EP 187. Now, as new data comes to hand, as we see how the Carpentaria wells produce, as we see what the type curves look like, as we see what the EURs per well are going to deliver, our valuation assumptions can change materially. Now, we then look at that and try and benchmark it against what the market is pricing in terms of peer groups, in pre-development, in production stages. And within that, and particularly at the bottom, where we can see that right now the market is pricing Empire at about 15 cents a gigajoule on a 2P plus 2C basis. But as you come into production and as some of that TC moves to 2P, as you start to develop it and move forward into generating revenue, there should be a re-rating. And if we use the re-rating that is equivalent to, say, a midpoint between Comet Ridge and Strike Energy at the top, that back solves into an implied share price of around 73 cents a share, which equates to our low end of our range. If we start looking at comparative transactions, the last transaction for gas at small scale and in the Northern Territory was a sale of part of Mereenie, which came at $1.43 for 2P producing reserves. And again, if we assume that the market doesn't imply that within the full 2P plus 2C, but only implies that into a 2P level, then the number that would equate to is around about 500 or low 500 in terms of 2P gas. And that would only require a 30% conversion of what is currently sitting at 2C. So effectively what it does is give us benchmark comfort around our valuation, but also highlights that higher margins, more rapid growth, gas prices higher than we're assuming, can easily get to our midpoint and even pushing towards the high point of our valuation once production starts up. Now, I'll leave it there, and that's all from me for the time being.
Thanks, Andrew. A great presentation, very detailed, and I think really sets the scene for the next part of today's webinar. Remember, a copy of Andrew's research can be found on the RaaS Research Group website, and Andrew will be available a little later to answer any questions you may have. Now it's time to hear directly from Empire Energy Group MD and CEO Alex Underwood, who will give the formal company presentation and also be on hand to answer any questions. Alex, look forward to your presentation. Over to you.
Thank you very much, David, and great to be online today. I really appreciate your time and that of all of your viewers, and also the analysis that Andy Williams has just provided. We'll just jump straight in. So first of all, on the next slide, we'll just go through a quick corporate snapshot of Empire. So we're listed on the ASX. We've got a market cap of around $260 million. We announced in our most recent quarterly that we have a cash balance of $51.6 million. This is by far the strongest financial position we've ever been in. Furthermore, since I joined the company, we have gone through a process of selling off all of our US assets, which has extinguished what used to be a very substantial debt position that we had. And so we've paid off all of the associated debt with those assets. We have a very small debt position, which is used to fund environmental liabilities. That's with Macquarie Bank, and it's indeed the team I worked in for 10 years. And we really appreciate their support. And we envisage further funding support from them in the years ahead. We recently raised money at 16 cents a share, and we were very well supported by both existing shareholders and a range of new investors. One of the key elements of that cap raise was that we saw very strong support for our cap raise from highly sophisticated US shale investors. Amongst those, Brian Sheffield, who is our second largest shareholder, provided cornerstone support for our raise. Brian was the founder of an American company called Parsley Energy, which was a developer of shale in West Texas, which he sold for $7 billion a few years ago. Brian has been investing heavily in the Beetaloo Basin because he sees that the Beetaloo has extraordinary geological characteristics and scale in a market that desperately needs new gas supply. We also were very grateful for the support of Liberty Oilfield Services. Liberty is the second largest provider of fracture stimulation services in America, and they are in the process of bringing some of their leading US technology to Australia to support the development of the Beetaloo Basin. Our largest shareholder, Pangaea Resources, is owned by Paul Fudge. Paul was a highly successful investor in the Queensland coal seam methane industry around 15 years ago. And similarly, Dale Elphinstone, our third largest shareholder, was a significant investor in and a board member of Queensland Gas Company, one of the most successful coal seam gas stories in Australian history. And we are very grateful for our shareholders' support. As Andy mentioned, we have seen some significant strengthening in our share price recently, and I agree with Andy's view that this recent raise removing an equity funding overhang has really helped with that. And I think with the news flow coming up that I'll go into more detail, I think we've got a very catalyst-rich environment that we're in. Moving to the next slide, I'm just going to go through a few of what I believe to be the key factors driving the investment case for Empire Energy. So first of all, the Beetaloo Basin is demonstrably one of the largest undeveloped gas deposits on Earth. It is the third largest shale gas deposit. It contains extremely large volumes of gas. It's a stacked play, and I'll step you through what that means shortly. But in just one of the four key productive zones, over 500 trillion cubic feet of gas is in place. That equates to over 400 years of Australian energy demand. And critically, it's a very low CO2 resource. Every gas basin in the world contains CO2 in the gas, in the deposit. And the Beetaloo has very low CO2, which we believe will be a very important competitive advantage going forward. Furthermore, we are about as close as you can get to the major LNG demand centres of North Asia. And certainly, it's part of our strategy to support both the local market and the East Coast market, which desperately need new supply. Not only is this a huge resource, but the geological characteristics of this resource are world-class. As Andy mentioned, the Marcellus is often used as a metric. The Marcellus shale now produces 25% of America's natural gas. It gives Americans some of the cheapest gas supply in the world. And yet we believe that the geological characteristics of the Beetaloo are as good as, if not better than those of the Marcellus. We have an enormous acreage holding within our assets. We have around 3 million net effective acres, which takes into account the different zones. And they're in very large continuous land holdings, which means we have a lot of running room to build on successes and continue to drill into the same geology. As Andy mentioned, we have held on to 100% working interest in all of our properties. And the royalty burden in Australia is actually significantly less than that of the US. So what that means is our shareholders will keep more of every dollar of revenue we generate. Moving on to the next slide, I'll just step through some further points. So we have an extremely large resource within our assets. We utilise the services of Netherlands Sewell & Associates, who I believe to be the most, one of the highest quality and most trusted resource assessors globally. They have assessed that we have over 47 trillion cubic feet of recoverable prospective resource. With a very limited amount of drilling, we have converted 1.6 trillion cubic feet to 2C contingent resource, which is a discovered resource. And we are now focused on moving into our first reserve position, which would occur once we can move into production and on demonstration of commercial flow rates. To put into perspective 47 trillion cubic feet of gas, an LNG train, which is a module of an LNG export terminal, in order for that to supply LNG into the market for 20 years, it would require around 4 trillion cubic feet of gas. So this is a huge resource. Recent appraisal drilling by us and other operators in the basin has demonstrated what I believe to be the commercial viability of the basin. And we were thrilled recently to sign a binding 10-year gas sales agreement with the Northern Territory government in an environment where Australian gas prices are typically trading at around 3 and potentially even 4 times those of the United States. Our focus as a company right now is on moving into pilot production at our Carpentaria project, and we hope to be in production by the middle of next year. And I'll step you more through our development strategy. Moving on to the next slide. Our acreage is contained on both the eastern and western sides of the Beetaloo Basin. We also have a huge acreage position further to the north in an area called the Greater Macarthur Basin. But given our desire to maintain capital constraint, our focus is on the Carpentaria project. We want to prove that this project is commercially viable, commence production from there, and look to build our production later. Despite being a relatively small part of our overall acreage position, EP187, which overlies the Carpentaria pilot project, contains around 5 trillion cubic feet of recoverable gas. We are also very fortunate, and it's somewhat serendipitous, that there's a pipeline that runs right through our tenement, which means that there is very little to no capital cost to us in connecting into pipeline infrastructure, and that will be the pipeline that will receive our first sales gas. Moving to the next slide. We have very, very thick shales across this area. So we have the thickest acreage across the basin, delineated in the purple there. And moving to the next slide, you'll see that it's what we refer to as a stacked play. So on the left, we have what's called a log section, which shows the best part of the Marcellus shale, which I referred to earlier. And as you can see, the Marcellus contains one key zone, and that zone is nowhere near as thick as all 4 of the productive zones in the Beetaloo. What this means is, as we work out how to optimally stimulate the shales to facilitate gas flow, we will be able to recover significant volumes of gas. The focus of Empire Energy and that of the other operators in the basin is on the Velkerri B shale right now as we get up that learning curve. But being a stacked play means that we'll be able to extract gas from other zones and do it in a highly capital efficient manner, because we'll be able to drill a lot of wells on each pad, potentially over 30 wells per well pad. What that means is less well pads, less surface disturbance, but also better economics for the project. Moving to the next slide, I'm now going to zoom in on the Carpentaria project itself. So on the left, we have a geological map of the Carpentaria area. And as those colours get darker and move into the blue and the purple, that's where we have the deeper shales. Since I joined the company, at which point this was completely unexplored ground, we have carried out 2 seismic surveys. We have drilled 4 wells. The first Carpentaria 1 was a vertical well drilled a few years ago. We stimulated all 4 of the zones and we recovered gas to surface from all 4 zones. That gave us the confidence to move into horizontal appraisal drilling. The US shale industry has demonstrated that the key to opening up shale reservoirs is to drill long horizontal wells and carry out fracture stimulation to provide the pathway for the gas to surface. Carpentaria 2H was a well that we were absolutely thrilled with. We got excellent flow rates, and that was from a short horizontal section, about 924 metres. Since then, we have drilled Carpentaria 3H, which was twice the horizontal length, twice as many stages, and moving on to Carpentaria 5H, which is fully funded, and we will be drilling, stimulating and flow testing later this year. That will be drilled from the same pad parallel to Carpentaria 2H, and we will be building our gas processing facilities, utilising the facility we've already acquired to put gas into the MacArthur River pipeline. This area, despite being a relatively small part of the Beetaloo Basin, contains over 200 drilling locations in the B shale and potentially another 600 locations across the other zones. Our focus is very much on the pilot project, demonstrating productivity and deliverability, but there is substantial running room going forward in future. Moving to the next slide, the key steps that we are looking to carry out with this pilot project will be, in the first instance, as I mentioned, drilling, stimulating and flow testing Carpentaria 5H. Then after this year's coming wet season, which goes from about Christmas through to April, we will be installing the Carpentaria gas plant, which used to produce gas on Sydney's outskirts for AGL, and then connecting it into the MacArthur River gas pipeline. That pipeline is owned by the Northern Territory government, and they have actually already built the T-piece, which is the connection into the pipeline from the proposed location of our gas plant. This represents a highly capital efficient approach to commencing gas sales, which is a big focus of mine, because we are looking to de-risk the project, book reserves, move into cash flow in the most capital efficient manner possible in order to minimise dilution to our shareholders and therefore maximise the reserves. Moving forward to the next slide, I'll just talk a little bit about Carpentaria 5H. This is going to be the longest horizontal shale well drilled in Australia to date. I should stress that our neighbours in the basin, Tamboran Resources, with their joint venture partners, Daly Waters Energy and Falcon Oil and Gas, are also looking at drilling 3-kilometre horizontal wells this year, and we wish them all the very best with that program. But to date, there's never been a well of this scale drilled in unconventional in Australia. So we're going to be drilling it parallel to our highly successful Carpentaria 2H well. We're going to be drilling it with about 3 times the horizontal length, 3 times as many fracture stimulation stages. And if we were to just replicate the result of Carpentaria 2H, our first highly successful appraisal well, we would expect around 3 times the flow rate. However, consistent with the learning journey that all companies go through in unconventional onshore gas developments around the world, we have learned a great deal about the geology, how to drill these wells, and we see opportunities for productivity enhancements on this next well. That is demonstrated on the next slide as follows. So first of all, we know we can drill long horizontal wells. The longest horizontal section we've drilled out of the 2 horizontals we've drilled so far was a 2.6 kilometre horizontal section. So getting to 3 kilometres is not much more of a step from there. But also we completed the 2 horizontal wells in 4.5-inch casing. We are now moving to 5.5-inch casing. Now, an inch of extra diameter on that horizontal section may not seem like a great deal, but it has a significant impact on the stimulation strategy. And the reason for that is that when you have more diameter of pipe to pump down the water and sand, which initiates the fracture network, you can pump down at higher rates and under higher pressure, which means that you can open up more rock and therefore, all other things being equal, recover more gas. We've been working with some very tier 1 experts out of the US to help us with our stimulation design. And we have been working with them to analyze the multiple different stimulation strategies we used in the first 2 wells to now move into a more optimized design, which is what is called a slick water frac. Slick water frac is essentially a form of stimulation where you reduce the level of chemicals and you basically have primarily water. There are still a few chemicals in there, but you're using less gels and more of a water-based system, which has been proven to drive productivity enhancements in the future. We've also learned a great deal about how to flow back these wells, which we believe will have a positive impact on long-term productivity. Moving forward into our next slide, I want to step you through the pathway to full field development. So, as I mentioned, this asset has significant potential for servicing the local NT market, which we believe is very important to support the local market, but then to resolve forecast supply shortfalls on Australia's east coast and ultimately provide energy security for our trading partners to our north. But what we need to do is really demonstrate that this is a commercially viable asset, and we believe that will bring in joint venture partners on attractive terms from around the world, and particularly to our north, where gas is a really important part of national security for countries like Japan, Korea, China, Singapore, and India moving forward. This year, we'll be drilling, stimulating, and flow testing Carpentaria 5H, following our recent well that is now fully funded, following our recent raise that's now fully funded. Then early next year, we will be installing surface facilities, commencing production, and then moving into planning for future work. We will have the capacity to drill more wells with the existing surface infrastructure through the existing facility and into the existing pipeline. And the idea there is to continue growing up the technical learning curve, recycling the capital that will generate through revenue from this pilot project, and really looking to book big reserves. In the years ahead, we anticipate that bigger pipelines will be built to the East Coast, and we are very appreciative of APA Group for their support as they look at potentially building big pipes to the east. Ultimately, in years ahead, there is ample scope for the connection of the Beetaloo into the LNG export terminals already present in Darwin, and I'm actually in Darwin right now, so they're just down the road, and into Gladstone on Australia's east coast. Moving to the next slide, ESG is becoming a critical part of the development of hydrocarbon resources in Australia. We are in an increasingly carbon-constrained world, and as I mentioned earlier, the Beetaloo has some of the lowest CO2 in the reservoir of any fields and potential new fields in Australia. We are required under the safeguard mechanism to offset all of our Scope 1 emissions from the commencement of sales, and we are very fortunate to have low CO2 in the reservoir, because our modelling indicates that at a notional $10 a gigajoule gas price, that would represent, just buying offsets would represent around 2% of gross revenue. So a relatively small impost. But I think in the modern world, we talk about ESG and we're all thinking about the E, but for our company, and particularly from my own perspective, the S and the G are critically important. We operate on Aboriginal land, we are coexisting with pastoral operations, and the social and governance aspects of ESG are absolutely critical for us. The reason I'm in the Northern Territory right now is that I and senior members of my team have been visiting with the traditional owners of the land on which we operate earlier this week. That'll continue later this week and into next week. And we're thrilled with the level of support we have from traditional owners who see this as an incredible opportunity for them to have self-determination over the economic development of their land and for economic development. We also work very closely with the pastoralists, and I'm very pleased that we're required. We have signed up to land access agreements with those pastoralists. Moving forward, onto the next slide. Gas is a pretty hot topic amongst in the political discourse in this country, and we are very pleased that we have the support of both the NT government and that of the federal government. The NT government's support for our activities has been absolutely fantastic. They have taken a very careful approach to this industry because fracking is an unfortunately not well understood technology, and a technology that causes great concern for people. And the government, since being in power in 2016, they put a moratorium in place for 2 years. They carried out an extensive scientific inquiry that found if the regulations were followed, the fracking could be carried out safely. It's one of the only jurisdictions globally to lift a ban on fracking. And the government, they've recently signed a gas sales agreement with us. The NT is fundamentally dependent on gas for its power. 80% of power here in Darwin comes from gas. Existing sources of gas supply have been in precipitous decline up here. And we are really excited about playing our role in not only providing energy security for the NT, but also the economic development that it will facilitate through royalties to the government, thousands of jobs. And you can see there a quote from the Chief Minister, Eva Lawler, showing her support and that of her government. Similarly, after a relatively rocky start between the Australian federal government and the gas industry, they have recently released their future gas strategy, which makes it clear that not only do we need gas through the transition, but well beyond 2050. It is a fundamental truth that there is no energy transition without gas, because I'm sure your viewers have heard many times before, the sun doesn't always shine and the wind doesn't always blow. And not only does gas have half the emissions of coal, but it can be switched on quickly to provide peaking power when required. Furthermore, as an interesting analogue, if you look at the United States energy mix, gas now provides around, I believe it's 42% of all of their power, and it has displaced coal to a great degree. That wasn't due to government mandates. It was actually due to gas being a cheaper feedstock than coal. And the US is now leading the world in emissions reduction, really because of switching from coal to gas. And we really look forward to playing our role in that. Moving to the next slide, we're nearly there. First of all, I just want to give everyone some context on the need for gas going forward. So for us, phase one of our project is very much focused on the Northern Australian gas market, and particularly providing energy into the Northern Territory. That blue chart you can see on the left shows the level of production from the Blacktip gas field, which is the predominant source of gas supply into the Darwin market. The contract is for 104 terajoules a day. It's typically only producing around 15 terajoules a day. So there is a desperate need for more supply into the NT market. And we are very pleased that we will be playing our role in supporting the local market. Once we get the local market supplied, our next aspiration is to send gas into Australia's East Coast. The chart you can see there with the red line on East Coast demand and the blue line on East Coast supply comes from the Australian Energy Market Operator. And as you can see, there are huge shortfalls coming into the market in years ahead. But also, my personal view, and it is just my view, I think that the demand forecasts for gas and electricity going forward are woefully underestimated. The advent of data centers and AI and the amount of data that we are all using, they are fundamentally energy dependent. And I think we are going to see huge increases in energy demand going forward. Across the Western world, as economies have grown, we have seen energy demand relatively flat in years gone by as we've become more efficient at using energy. But we're now starting to see across the Western world that energy demand is starting to take off again. So we're going to need more gas. Furthermore, our longer term aspiration is to supply LNG to our north. This chart here from the Shell Annual Energy Outlook shows that there is not enough LNG in the system. So we're going to see more LNG development going forward to provide the energy needs of our neighbours to the north. Moving on to the next slide, I'll just provide a bit more detail about the gas sales agreement we recently signed with the NT government. Here in this photo, from left to right, you can see our Chairman Peter Cleary, Chief Minister Eva Lawler, Resources Minister Mark Monaghan and I at the signing of our contract. It's a 10-year contract, which is for up to 25 terajoules a day. And the 25 terajoules a day, to put that into perspective, is the capacity of the pipe, and it represents around 40 to 50% of gas demand for power in Darwin. But also we recognise that long-term energy security is important for the NT and its people. And so we have also offered, and the government has accepted, an option for the NT government to buy an additional 10% of our supply for another 10 years if we can get up to scale of 100 terajoules a day or more. We aren't allowed to talk about the pricing, but we believe it's a competitive price that is fair for both buyer and seller, and it's done on an ex-field take or pay basis, delivering into the NT government. The key condition precedent to completion of that contract is for us to reach a final investment decision on the pilot project. Regulatory approvals are very well advanced, and we're just working through those processes now. Just moving on to the next slide. As I mentioned before, we are very strategically located to the major demand centres of the world. The vast majority of LNG demand globally is into the growing economies of Asia, and you can't get much closer to Asia than the Northern Territory. Furthermore, LNG prices are remaining consistently high, and I believe that will persist for some time, which provides a very strong market for us going forward. Just to start wrapping up, if we move to the next slide, I just want to repeat our company's strategy. So phase one, pilot project into the existing pipeline, demonstrating the productivity of this resource while generating revenue so that we can recycle that capital into more activity. We're very well advanced on those plans. Phase two would look at sending gas into Australia's east coast, and phase three could be very substantial volumes, around 40 times the size of the pilot project into LNG export. Just on the final slide, I'm just going to take you through some of the investor catalysts we have coming up. So we are very, very close to announcing the execution of contracts for both the drilling rig and the stimulation spread for the upcoming Carpentaria 5H program. We are already approved for the drilling, stimulation and flow testing of this next well, and we're just completing the regulatory and Indigenous approval processes to sell that gas. Then we'll be carrying out the drilling, stimulation and well testing. Andy mentioned that he believes that we might be there to first gas from an equity perspective. I certainly won't make that promise as director of a public company, but what I would say is that for the additional capital we require to install the surface facilities, we are very well advanced on a debt process that would involve a modest level of debt. Macquarie have been very supportive of us in recent years against R&D tax rebate funding, and we're looking at that again. Then after the wet season, we'll put in the surface facilities and look to commence sales in the middle of next year. So on that note, I might just pause, and David, if you've got any questions, I'd be very happy to answer them.
Thanks, Alex. Great presentation, comprehensive overview of the Empire Energy business. As you said, Q&A, we've got a stack of questions, so let's just jump straight into it. I will welcome Andrew back as well to participate in this. A number of questions regarding FID. What's the timing, and what are probably the steps that need to be ticked before that decision can be made?
So I'll be a bit careful on timing, because I only like to provide timing forecasts on matters that are completely within my control. But we are certainly approaching that FID point very rapidly. In order for us to approach our board for an FID on the pilot project, we need to get all of our regulatory approvals in place. That includes a consent from the traditional owners for the sale of gas. That would be an addendum to an existing agreement we have with the traditional owners. As I mentioned, I've been carrying out consultation with senior members of my team recently and going forward, and there's a very strong level of support for our project from the traditional owners. We are working through the final financing steps on the surface facilities, and that would look to have us moving into FID on the pilot very soon in the coming months. But we're not letting that process hold up our progress on the drilling. So we do expect to be out drilling early to mid next quarter, so that we can get the well drilled and the well fracked and flow tested before the wet season.
Andrew, a question for you, and it probably looks to the comparables to other companies operating either in the NT or wider into Queensland. You touched on it during your presentation. The question here is how do they all sit and how do they compare, and what makes Empire stand out to you based on a comparable with other exploration companies, and how much of what they're doing adds value to what Empire is doing, either from an exploration point of view or even a market point of view?
That's not a simple question to answer. In fact, it's quite complicated with a number of moving parts. But if we just take sort of direct peers within the NT, I'm a firm believer that a rising tide lifts all boats. And given the consistency in geology that you're seeing within the wells that are being drilled today within the Beetaloo, a lot of those results are transferable and provide direct look through. So the more activity you're seeing from Tamboran joint venture from Empire, the more it reduces the risk, or at least clarifies and better defines the development model. In terms of what we're seeing in comparative metrics against other sort of peer-listed companies, look, it's an interesting one because ostensibly you should have the same companies operating in the same areas being priced the same way, and it doesn't go that way. There's again, there's still this overhang within the Beetaloo being considered as an early stage basin, with I guess still uncertainties around how first gas looks and how the pilot project looks. But we would expect that from an operational and commissioning perspective to unwind as the project starts and continues. And you should start to see the value of that gas come through in quarterly reports. So you should start to see the value of that gas being reflected more within the asset bases. Now, we pick the top end, which was Comet Ridge, which is in a pre-development stage, but has been there a while and may not take FID again until the end of the year for a 2026 startup. So it will have a discount on time. We look at Strike Energy, which is in production, but it's a WA domestic gas producer, and those prices are lower. So we see it as a reasonable expectation of a re-rating metric that as Empire moves into production and through production, through the commissioning, that the market should at least be able to look at that as an equivalent sort of metric as a benchmark.
Alex, how important is the development and your development and the broader Beetaloo Basin for energy security in the Northern Territory and Australia more generally?
So, as I mentioned in my presentation, we are facing critical gas shortfalls both in the Northern Territory and on Australia's east coast. And I think, one thing that people outside the gas industry don't realise is that the demand and supply dynamics of gas are highly, highly inelastic. And what I mean by that is a relatively small gas shortfall can create enormous spikes in the price. And we saw that during when the Ukraine war kicked off, when LNG prices went from $10 or $12, which in itself is a very healthy price for a producer, and spikes to $50, $60, $70, which fundamentally has a devastatingly negative impact on economic activity, because energy is, first of all, it's critical for our modern daily lives. We wouldn't be having this conversation without energy and gas, particularly here in Darwin, where all the electricity comes from gas. But also it hurts manufacturing. So, it's my personal view as a proud Australian that we desperately need new gas supply, and the lead time for projects is very long. So, we are thinking 5 and 10 years ahead as a company, but we're still looking at helping to resolve very short-term problems. I think then if you look further afield at where plentiful gas supply has been beneficial, there's no better case study than the United States. So the US gas price used to be, at the start of my career, $7 or $8. Now it's down in the low twos. It's still profitable to drill gas wells over there because shale has become so efficient and so profitable. And yet the impact of plentiful gas supply on the US economy cannot be understated. When the global financial crisis hit, I think a lot of people think that zero interest rates saved the US economy. I actually think that cheap energy had as much of an effect on saving the US economy from the financial crisis, because you saw it, manufacturing was moving back. I mean, car manufacturers used to move their plants out of the US to Mexico, where Mexico had cheap labor. Now they're all moving their plants home because the cheap energy offsets high wages. So I think cheap and affordable energy is critical for everything. And I see a tremendous opportunity for us, not only to provide that security, but really provide a stimulus to economic growth for decades ahead.
A bit of a technical question here, so apologies if I get it wrong. But in terms of a key value driver for investors in the company, is unlocking the stacked play characteristics of EP 187 sort of a key element to that?
Yeah, I think as a company, we aspire to one day down the track produce lots and lots of gas. But actually, what's going to drive value for our shareholders is de-risking this play. So moving this huge resource from prospective resource to contingent resource and ultimately to 2P reserves. And we saw this in the coal seam methane plays of Queensland 15 or 20 years ago. So, you know, I mentioned Queensland Gas before, a company that one of our major shareholders, Dale Elphinstone, played a critical role in. So QGC, it bobbed along at 10 or 15, 20 cents a share for many, many years as they de-risked. And then they went through this enormous hockey stick share price growth and value growth, where I think the takeout price was $5.65 a share. And it was because they de-risked a very, very large resource, which became irresistible to major international oil and gas companies. So our key focus as a company, you know, we are focused on supporting the local market, getting cash flow going, but what will really drive value for our shareholders is converting these resources to reserves, which will really underpin the value. And it's because we have so much running room. We have hundreds, thousands of drilling locations, and it may not be us that drills all those wells in the future, but if we can prove that all the acreage around us is economic, we create a lot of value there.
Just touching on the point you've just made, so what development is needed to move resources from contingent to 2P reserve?
Yeah, so a contingent resource is a discovered resource, but there are certain contingencies that prevent it moving to reserves. So the contingencies for us are, first of all, access to market, which we will resolve by building the gas processing plant and connecting it into the pipe. Then we also need a commitment from our board to develop the project. And, you know, I don't want to speak for my board, of course, but I'm relatively confident that if we show economic viability, that there will be an incentive for us to move forward. And then also the critical thing, and our real focus as a company at the moment, is on demonstrating that the resource is economically viable. And so what that means is punching in the gas price into the financial model, but also punching in the expected, what we call the type curve, which is the expected production over the life of a well. And that is what we are really focused on. So while this pilot project is going to be awesome for us because we'll start generating revenue, the real goal of this pilot is actually producing these wells for a long time, longer than 30 or 90 days, but over the long time, so we can understand what is the shape of that curve, and therefore we can demonstrate it's economically viable.
This is actually a question that I think I'm going to put to both of you. Final question, but a good one. I'll start with you, Andrew, and then Alex, if you want to sort of give your views on it as well. So the question here is actually from, it appears, a small cap fund. My question relates to institutions involved in EEG. It has been commented that institutions have been waiting or holding off to see the company progress more before making commitment to the stock. How are institutions viewing the stock? Are there any milestones institutions are waiting for? And if so, what are they?
That's a very good question, and probably alludes a little bit back to the early part of my presentation, where I mentioned that although a lot of the investing community is very supportive of the thematic, you know, short gas, rising prices, supply constrained, they've been very slow to sort of take it up because they've effectively wanted to wait to see new gas come through. So, and that's a little bit like big companies don't move early in partnering, tend to not move early. They want to see the risk getting taken out. So we are seeing more interest. We are seeing more inquiries come through, and you are seeing more background work being done, particularly on those companies that are progressing their projects. And I will say to the a little bit of a brickbat to the industry is that they've been very slow in making that progress over the last few years, and there's been a number of false starts. So Empire's in a very good position from that perspective by having worked their asset base and being on that cusp of first production. So from a bigger institutional perspective, and particularly now that the capital raising overhangs are moving, but the liquidity in a company like Empire is growing, that's becoming more and more attractive to bigger funds.
Alex?
Yeah, so David, before I answer that question, I'm going to share an anecdote with you from earlier in my career. So as I mentioned, I worked in the energy capital division of Macquarie for 10 years. And I was very fortunate to be able to have that opportunity because we were a business that was using the bank's balance sheet. It wasn't external fund money or anything to invest in smaller oil and gas companies. We had the ability to rise the cap stack from ordinary equity and public and private companies right through to debt. And I was very fortunate to be the guy in the Sydney office who used to get the calls from, the institutional desks of the brokers and the ECM teams when cap raises were coming. And we were very fortunate to be shown a lot of opportunities in coal seam gas. What we didn't really get at the time was that this is what you call a resource play. So it's not about what price earnings multiple you're going to have in 2 years' time. It's about proving up a resource, and that's where the value comes. And we saw all the coal seam opportunities, and we didn't invest in any of them, which I think we're probably still kicking ourselves for all these years later. But it was because it was early days, right? So in coal seam, the wells used to cost $5 million. Now they cost $1 million. They used to come on at 200,000 or 300,000 cubic feet a day. Now they come on at over 1 million cubic feet a day. And we also had another issue then, which we don't have now, which was that we had a closed domestic gas market. So we had very low gas prices. I certainly have learned a lot from that over the years in my own investing style and the way we're building our strategy around this company. But going to the institutional makeup on our register, I've been doing this for about 6 years, and I must say it was really hard in the early days getting institutional interest in our stock. And, it was a very, very heavily high net worth dominated register. And that was due to some of the reasons Andy's just mentioned. So it was a very early stage play, which made it a bit more of a digital risk if it's going to work or not. We had a very low market cap. We had very, very low liquidity in our stock. But as we've matured the resource, we've actually seen a significant increase, still relatively modest, but a significant increase in the institutional makeup of our register. So I'd estimate that probably 15-20% of our register is instos now, which would have been sort of 3 or 4% only 12 months ago. And it's not only due to the market cap and liquidity hurdles that we've now moved through, but also I think a lot of those instos are starting to see this more as appraisal risk as opposed to exploration risk. And indeed, I don't want to breach the confidence of any investors who have supported us recently, but we have seen some Aussie instos starting to come onto our register, but also US institutions that understand shale gas have been really starting to support us in quite a meaningful way because, they see stocks like Empire and Tamboran as being incredibly cheap on the metric they look at, which is dollars per acre, where, I think Empire is probably trading at, 100 Australian dollars an acre, whereas the fully developed assets in the US now, or, the matured resources, they'll trade at 30, 40, 50,000 US dollars an acre. So they see a very asymmetric risk profile. And I think we're finally starting to get some momentum there on the insto side.
Well, that brings to a close the Q&A element. We've exhausted all the questions. A lot of questions have come in. So thanks everyone for participating in the Q&A and supplying all those great questions. Thank you, Andrew and Alex, for presenting today. And I'd also like to thank each of the attendees for your participation in the webinar and engaging in the Q&A. We hope you found this webinar informative and valuable, and we look forward to seeing you at our future events, where we'll once again dive deep into the analysis of another promising ASX listed stock. Thanks, Andrew and Alex.
Thank you, David.
Thank you.
And thanks everyone for participating and have a great day.